versus hold strategy. Well, every investor in UAE who's buying a property in Dubai, the first question which he has in his mind is whether I should buy the property to flip it or stay long in that. If I speak about myself, I do both strategy, mainly holding for long. But today we are going to see a full breakdown on flipping versus holding for long. So let's get started. The number one thing related to flipping is people who don't know about flipping strategy, they should know these realities before even thinking to buy a property by just paying 20% and then thinking I will pay 1% by time and I will flip when the price goes up. So you have to make sure that when you want to do a flipping strategy and you don't have enough money to give in the next 2 or 3 years to the developer, and you will flip in between, let's say in 1 year or 2 years down the line, then make sure that you are buying on the launch price and below the market price. So let's say you are getting a discount from developer on the launch price when the launch date is there, or you are submitting your EOIs to get the best price and it is literally below the market price, then only you will be able to gain a profit in flipping strategy. And then and then you should not be keeping in this mind that waiting for the market to move or project to complete. If you use this strategy, it's like again doing the technical stock trading, that you should not be getting into emotional aspect of the investment. You should make sure that the moment market moves and the momentum is there, you have to flip it. Don't just wait for the highest level to get your maximum ROI, but flip it the moment you see you have gained 10 to 15% of the return per square feet level or per unit level what you have bought. Again, zero about flipping strategy, there is zero capital gain tax in UAE, as we all know. On the personal income, there is no capital gain tax. Best suited only at the launch level. So who the candidates, the people, the investors who want to do flipping strategy, make sure you buy at off on the launch, and that too discounted, and make sure the project which you are buying has high transaction volume, because if you need to flip in next 18 to 24 months, the project should have high transaction volume, not a developer which is not known, the project which is lesser known. It should be a very very well known project and should have a great transaction volume. Then if we speak about holding strategy, then in that case, you can do holding strategy in off plan also, but I would say I would compare it with the secondary market where the property is already ready. So it can give you a rental income as well. It gives you 20% leverage by putting down payment with the bank, and 80% you will be getting from the bank as a finance, and you own the 100% of the asset. This I had discussed in my last video as well, how you can use real estate investments by getting a leverage of 5x, which means paying 20% and getting the ownership of 100%. Now, in holding strategy, you get dual returns. One is a rental yield, which would be around 5 to 7%, and a capital appreciation of 5%. So, together, your yield will be 10 to 12%. Again, zero tax on rental income in UAE. Time does the work, because the longer you hold, the return grows. So this, the candidates, the investors who are looking for long term investments, they can definitely vouch for getting at least 10 to 12% return with rental and appreciation. Now let's compare the same asset class with flipping strategy and the holding strategy. So the flipping strategy, the goal is profit on exit, one time profit on exit. So you bought today the unit on a launch price or discounted price, and you will exit after 18 months with, let's say, 10 to 15% of your margin. That is it. And then if we compare it to hold strategy, it is for rental yield and long term appreciation. Now, typical holding period in a flip strategy would be 6 months to, I would say, 24 months at best case, or 30 months, and hold strategy at least 5 years. Now, there is no income during this period in flip strategy, but in holding strategy, you are getting monthly rent income. That's your cash flow. Capital required, full purchase price. In holding strategy, it will be again leverage used by the bank. Flipping strategy, if you're in off plan, again you will be paying 20%, but that is the whole capital which you are giving it to the developer, plus paying every month 1% or 2% depending on what project you have invested in. Leverage, again, very rarely, because this is more of a cash deal that you can take on launch price or discounted price. So you will get less price, but again, leverage is very less. But in holding, the bank is giving you the leverage with 80% LTV. Market timing is most important in flip strategy because you have to exit after 18 to 24 months. But in holding strategy, again, you have that cushion because it's a long term investment. So somewhere in the cycle you can wait for a longer period of time, but in flip strategy, because you have to sell, that means your timing of entry and exit is most important, and I think that is the only variable which you need to control. What is the risk? Price drop, slow market, high cost, because you have already defined your entry and exit. So if there is a price drop, still you have to sell. If there is a slow market, still you have to sell. And if there is cost, and the costs which are related to flipping in such a short time of period, the cost will still remain the same. It will not flatten because you have only 2 to 3 years to sell that. Considering it with the hold strategy, yes, there can be vacancy risk if your property is not rented, rate rise of the interest rates, and a bad tenant. These are the risk in the hold strategy. Now, effort for flipping strategy, I believe the effort is much higher because you're continuously watching the market, looking for the buyer to sell your property before time. So you have to time your exit. That means you have to actively be involved in the flip strategy. You cannot be just buying and sitting. You have to actively involve to find a customer, investor, or a broker to sell your property. On the whole strategy, again, it's a passive one. It is a long term strategy, long term ROI. Tax remains both in both strategies, the tax remains the same. Now if I have to speak about the conditions, specific conditions that make me consider that I should be more focusing on the hold strategy, not on the flip strategy, because when we are trying to buy on off plan property for the flip strategy, it is very difficult to get the right price. Then we have to make sure that area is appreciating very fast in that short period of time. I mean, we have to make sure that we are buying at the right price, below the market price. Then we have to make sure that the area is appreciating fast in a very short period of time. Need liquidity for another opportunity because we have put all our cash in that unit. Property will not have any rental demand, and there is no mortgage possible as well. So these are the reasons, because there are too many variables that always stop me to go into a flip strategy. And as an investor, I have always been focused on long term perspective as well, so I don't personally choose flip strategy. Now, why I choose hold strategy? Because it gives me a guaranteed rental yield of 7%. Mortgage is able to easily cover the rent, so my I have a positive cash flow in my account. Strong long term demand in that area, so I'm investing in Dubai South today. I know next 5 years the area will be developed, or Dubai Maritime City, or any area for that matter. So long term I have the option to keep the unit and get the maximum benefit on hold strategy. Again, property is part of long term wealth creation, not short exits. And market is flat, that will beat, if the market is flat, that will still beat the long term ROI, because I'm still getting the rental demand. So if first 3 years the appreciation is not there, maybe next 3 years I will see the appreciation, but first 3 years I was able to get the rental ROI from my property. As Robert Kiyosaki, who has written Rich Dad and Poor Dad, also mentions about how to use real estate leverage and the cash flow, I use his strategies only. Now, I would like to know your questions, and I would like to answer what is your strategy, what do you think makes more sense, and we can have an open discussion about that. You can DM me property and I'll share more frameworks related to how I have created the framework when using when buying a secondary property, not just any property. So if you're looking for anything related to that, you can DM me, put in our LinkedIn live session or YouTube session your comments. I'll be happy to answer that. Thank you so much for joining today.